I've opened a demo account with XM, and it has 1,000 rands in it. So I opened it in rands. So we're gonna go through, try to raise that demo account together in the coming weeks, in the couple of weeks. And if you do have your demo account, I think we can mirror trades. Some of the trades we can have pending order trades. That means that we do analysis, and if we think maybe we want to enter at a certain price, then we'll put a stop order, or and then we will try to enter at that price. And the market will execute that a trade at that price. So that's what we're gonna be doing with the demo account. So we'll start using I'll also use the demo account when I'm illustrating some of the concept here. So that means that if I'm trying to explain the spread and the leveraging part of it, as well as how to execute trades and stuff, I'll show you that using the demo account. I think last week, or the first class, I was using my real account, so we couldn't really have much freedom to explore the account, because it I can't just be placing random trades on the real account. But with the demo account, that's what we're gonna do, right? So I just want to show you. Can you guys see my presentation? The screen that I'm showing.
Yes, you can.
Okay, perfect. Let me just do this. Is it still visible?
Yeah.
Okay. So I just want to show you why would you want to trade Forex. And so in terms of daily volume that is being traded compared to other assets, Forex trading, as you can see from the graph with the blue column, the blue bar, you can see that Forex trading in a day, 5.3 trillion US dollars is traded, and that's a lot of money. All right, so you have your institutions that are busy trading, your banks and many other institutions, asset managers, they trade Forex trading. So now, just to get a view of how much that is, if you check here, the next asset, which is the futures market, it has 437 billion traded in a day, and that's about, if you check on Forex, which is 5.3, that's Forex is 12 times more than the futures market. So there's really a lot of money that is being traded, and I just wasn't able to get proper statistics on how much retail traders contribute towards the market. But I do know that we don't contribute a significant amount of this. But in terms of growth of retail traders, we are growing. There's more of retail traders in the industry. In fact, in South Africa, you have most successful traders, in terms of trading, retail traders, they come from South Africa. Most of them, they're coming from South Africa. So it means that more people are going into Forex trading, and they are really dedicating their time into understanding what goes on to the market and how to trade and how to become a profitable trader. So yeah, this, as I mentioned last time, this is an ongoing process. So when you want to trade, so you have to consistently build your knowledge. So it's always an ongoing process. So you keep on feeding yourself with knowledge and discussing with other people and asking yourself, well, what is it that you don't know? And then you go and find out that, right? So in Forex trading, the advantages is that you can trade 24 hours, unlike the other markets where your equities, they do open maybe from 9 and then they close at 5. Like, for example, in South Africa, the JSE closes at 5. So you have a closing bell around 5, and then that is in stocks right there. And then you have minimal or no commission. You have less commission for Forex trading, so you don't pay a lot. Probably you pay a lot based on your leverage that you're using, and maybe the broker that you're using. Some brokers have high spread, so you can pay depending on that, right? So I don't know if you guys can be able to admit people as they want to enter the group, the meeting. So if you are able, may you please assist me with that as I'm doing the presentation. All right. So I know with stocks you have a few brokers that are upcoming, like your Easy Equities, where now you can be able to trade or execute, buy stocks at a minimal cost, right? And then instant execution of market orders. So at the forex market, the moment you press buy, you are instantly in the active. You instantly activate a trade. So it means that you have an instant execution. So it's highly it's live. So there's no need for you to go through a certain broker that will just tell you that the price that you want to buy at is not available, blah 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 blah, right? And short selling without an uptick. Is someone saying anything? Taba? Okay.
No, I'm not saying anything, sir.
Okay, no problem. So yeah, there's you can do short selling, you can do no middleman, no market manipulation. Well, I don't necessarily agree with that much. As I don't know if you know of recent cases against bank who were manipulating the rand. So there is a bit of that in market manipulation in the market. So yeah. Even on stocks, it does exist. So, okay, let's move on to the next slide. So these are the major currency pairs that are usually traded in the market. So you have your Euro USD, USD JPY, GBP USD, USD Swiss franc, and USD CAD, Australian dollar against USD, New Zealand dollar against United States. And this is how you sort of like pronounce the countries. That's the Eurozone against the USD, the United States, and yeah, and it also depends on how you what is your preference in terms of pronouncing the currencies, right? So, for example, this one that is Swiss franc. Some people call it Swissy, some people would just call it CHF, right? So that's just all up to you in terms of your preference. Okay, and then so with the market hours of forex trading, they vary depending on your location and the season that you are at. So in for example, these are summer market operating market hours. So if you check here, we often look at the GMT because if you look at the GMT, what you need to do is to see what time does the market open and close in terms of South African hours. Then you would add +2 on each and every hour that you see here. So say for example the Sydney opens at 10 p.m. then you would have to add 10 p.m. GMT. So it means that if you add 2 hours here, then it's going to be 12 p.m. GMT, right? So which means that the Sydney market will be opening. So when they open, you can see when you're trading that there's going to be a huge volume, like the market can become a bit volatile. So there's more trading activities that are happening. So you do have your silent hours where now there's not much trading activities that is happening in the market. So, and then some of those hours are towards your weekend, right? So people during the weekend they pull out their money, so they're hardly not trading. So on Friday you hardly have much of trading activity, and if you have much of a trading activity, it could be fundamental news, say your NFP. For those that know what NFP is, like US reporting on unemployment. So then when they report on that, you have some activity that is happening on the market. So the market becomes very sensitive. So most people, they do trade that fundamental news, right? And then you have your Tokyo opening at 11, that is the Japanese. And then you have your London opening at 7, which is 9 a.m. Here in South Africa. And then you have your New York opening at 12, which is around 2 p.m. here in South Africa, right? And with these opening hours, so what you can see is that there's a time when maybe the London is open and the US are open. So when they're clashing, so that's when you have the most trading activities in most of the currencies, especially if you're trading the US dollar against other pairs, or the British pound against other pairs, or the euro against other pairs. And then these are market hours in winter. So if you check here, they just vary by an hour. So in winter, the sun sets early, so the market tries to close earlier. So if you check in Sydney, it's 7 a.m. That is closing. So when you come here in winter, it's about 6 a.m. closing, right? So this is all to assist you when you're trading. So maybe if you're a scalper, I did mention that scalpers, they trade for a few hours or a few minutes in the market, so they enter for a few minutes. So if you're a scalper, then you'd want to know when is the most active hour that you can trade. So you have the most people that are trading at that time. So you wanna trade when there's too much volume, and then you do have for people that do long on the market. And then swing traders, for example, they it doesn't really matter to them what hours they're entering, because their prospect is to maybe hold a trade for a day, 2 or 3 days, right? And then this is just the volume distribution of the currencies in the market. So the most dominant one is the Euro USD, which is highly traded. Most millionaires make money through these Euro USD currency. And you have your USD JPY, which is also highly traded. You have your GBP USD, about 9% of it is the volume that is traded in a day. And then you have your AUD USD 6%, and the rest others, which includes your USDs, the South African currency, against USD, and GBPs they are all included in the others here. So some of them, they're not highly traded. I know our currency is highly volatile, so when you trade there, you need to be more careful. Okay. So I think, okay, I've explained most of this stuff. So this is like how you pronounce your currency. The first currency will be your base, and the quoted currency will be the ZAR in this instance. And you have your pips. So if with the pips, okay, you do have the difference between these two prices. Say after a minute, the price moved from 2538 to 2548, then the 0.0001, that 10 difference is the pip, right? So those are your pips. And I think I did explain this last time. So with the bid price and ask price, you'll see that on the platform, and your spread usually varies depending on the broker that you're using. So you have the difference between the ask and the bid price. That's the spread you pay when you are executing your trade. So usually when you execute your trade, you find that the trade is negative. So that's usually the spread, right? Then you have your margin. I'll also explain that as I'm doing the platform, going through the platform. And you have your leverage. So leverage allows you to open many multiple positions at the same time, right? So the higher the leverage, the more you can be able to open many trades. And then you have your types of orders. So the type of orders, you have your market order, which is the price that you enter at current market. So for example, okay, I'll just go through this again when I'm going through the platform. So say you find Euro USD trading at 1.45, right? So if you sell it at that time, so that's the market order that you're gonna be placing at that time. And then you have your limit entry order. So you have your buy limit or sell limit. So these ones are usually pending orders, right? And then I'm going to show you how you execute them. So if you want to buy the market at a certain price, but the market hasn't reached that price as yet, so you can place a buy limit such that when the market reaches that price, then it executes a buy instantly for you, right? And then you have your buy stop and sell stop. buy stop and sell stops, it's usually the opposite of if you have a buy limit, the buy stop, then it means that it's gonna sell the market for you at that price that is that the market is gonna be moving at. So some of these concepts you'll get to understand them more as we are playing with the platform, because I intend on doing the live trades with you guys. So, and then you have your stop loss order. So your stop loss order is the one that protects you from blowing your account. So if you say you are trading and then now it depends on your risk. So if you trade, open a trade and then you open it and it's a sell, right? So if the market goes against your direction, so now it means that maybe the bulls are winning over that trade. So instead of you losing your entire capital, you can put a stop loss order at a certain level, where now if the market reaches that level, you will be automatically selling your position, leaving you with some of the capital to your account. So that's the advantage of the stop loss order. So with some, they don't use it, and some they use it. And if you don't use it, you probably have some capital that you are willing to lose, because the market can go otherwise, and then you can lose your entire capital, right? But I can encourage you to use stop loss order as you are beginning, so that you can understand how you don't blow out your entire capital in the beginning. Okay, and then you have your take profit. So once you've done your analysis, then you have levels where you want to exit your trade. So after you've determined those levels, then you can place a take profit at that level, which is the price. So then the market will instantly sell your position, leaving you with some profits, right? And with the stop loss order, if you are in a profitable trade, you can also adjust it, right? So this is called in terms of trading, it's more of risk management. So if you see that your trade is on the winning side, then you can adjust your stop loss order, so that when it gets hit maybe at a profit side. So it can be after, you can adjust it after to go after the market order, right? So that when you're done, if the market goes against you, then you can lock in some of the profits. So that's called locking in some of the profits, right? Using the stop loss order. And then these are the candlesticks, right? So you have your bullish candle, which is this one that has a body without anything inside it, it's empty. And you have your bearish candle, which is the dark one that is filled with the black color. So with the bullish candle, how do you identify it? So it opens at a lower price. So in the market, this will be your lower price. So when it opens here and it closes at a higher price, right? So it opened low and closed high. So when it's closing higher, it's forming this body of the candle, right? So you'll see this more when we are looking at the charts. And then you have what the market is doing here with these shadows. That's your lower shadow and your upper shadow. So your lower shadow, some they call them wicks, right? So wicks, which is WICK. You have this lower shadow. It means that during the period when the market opened, it once reached this lower level here. So that's why it's defined as a low. So that's the lower shadow. So you have your market once went down to a price below the opening price, right? And then it went down to a certain level down here. So it's formed this week, and then it started going up again. So when it went up to beyond the closing price. When it went beyond the closing price, so what it did is it went up before it can determine the closing price. It went up, forming a higher shadow, and then it went down, forming a closing price. So it closed at this price here, and then whatever happened above here is a wick, right? And then you have your bearish candlestick. So with the bearish candlestick, it's identified with this filled body with the black. So it in the platform, it depends on your preference, right? So you can change the colors and whatnot of the body of these candles. So what you have is the market opens at a higher price and closes at a lower price. So it does completely the opposite of the bullish candle. So with a bearish candle, it opens at a higher price and closes at a lower price. And then with the high, it's the same concept as the bullish candle. So the price that was high during the trading period for that market, for the formation period of that candle, it forms your high shadow, and then the price that was lower, it forms your lower shadow, right? So that's how you identify the candlesticks, right? So is there anyone with any questions so far, and are you guys following? Okay, I'm gonna go to the other presentation. Let me just do that. Yeah, while I'm opening the MT4, I'd like to know from you guys, did you guys manage to download the platform? Or maybe can you raise hands for those who have the MT4 or MT5 platforms, so that I can see those that understand and those that don't understand. Hello, can you guys hear me?
Yeah, we can hear you.
Yeah. Did you guys manage to download the MT4 platform? Khalid, do you have one?
Yes, I do. I think we raised our hands. Yeah.
Oh, okay. I can see that Takalani, Donald, and Nomtedo. Okay, Palesa, Tabang. Are you guys having the platform with you, or are you guys familiar with the platform?
Nope, we are not familiar with the platform. For me, I'm not. I just want to learn.
Okay, so I'll do just a brief introduction to the platform, and then I'll try to move faster for those that have done this before. And then with some of the questions, you can also WhatsApp me or on the group. I'm the guy who sent the message on the group right there. So with Palesa, are you okay? Tabang?
Yeah, now I'm okay. I'm okay, sir. I'm familiar with the platform. Trader for.
Okay, cool. Can you guys see my screen now? I'm sharing.
Yes, we can.
Yeah, so I'm using XM and it's MT5, and so for the sake of time, those that have never opened a demo account, you can try opening one with XM or any broker that I sent to the group, and more people suggested more brokers on the group, so you can try to open a trading platform with a demo account with them, and then just so that you can familiarize yourself with the platform. Okay. And then so yeah, this is the platform here. And so last time I did show you that this is how you access your currencies. You can come here to Forex and look at the exotics one, majors, your minors. Under the exotics, you can find your USDs are here and other currencies. Sorry. You can find your majors here, which are usually the most traded currencies: Euro USD, GBP USD, the ones that I did mention on that presentation. And then so with the advantages of MT5, you can be able to trade other asset classes like your futures, which is your commodities, energies, and indices, right? You can also trade cash indices. So these are your index. Like if you want to trade what do you call S&P 500, you can trade it here. It's US 500 cash. and you can trade your Nasdaq, which is your US 30, and so on and so forth, right? So these are mostly from different. They represent what do you call the on the side of equities. So if you want to trade, these are indices, right? So it's just a basket of all top 500 US companies in one index, right? And then let me not go too much into that, right? So if you are attending the shares investments class, you will see Jet will explain to you more about this. And then you can also trade CFDs on stocks. So that's the advantages of this platform, right? So if you want to trade your Apple, you can use this one, your Alibaba and other stocks that you're interested in trading, right? So that's just it. So if you are looking for a currency on this side under Forex and you cannot find it, so you can come to this market watch if the window is there, and then you can click on show all. It will be visible. And then if you click on show all, then if you go back, you can be able to access your currency, right? And then here, so these are the candlesticks that I was talking about. So let me zoom in so that you can see better. So in this case, it's white. The white ones are bearish, and then the ones that are empty, which is having a dark color, it's bullish candles, right? And then most of these candles, they have meanings, right? So for example, if a candle is like for example, this candle, right? So this is what we call a doji, right? And then you can have it forming a morning star, a rising star, and so on and so forth, right? So it usually presents indecision in the market. So these are part of reversal patterns that we're gonna go through. These are signals that you get in the market to show you that the market might reverse from the direction that it's taken. So in this instance, the market was going up for a certain period of time. This came, you have a bit of indecision. So most people were buying. This is the trend that was happening in this 50 minutes. So the market was going up, and then now after this indecision, you have the sellers. They started coming into the market. Now they start selling, and then there's just a minor fight there. The bulls came back, and then now you have this other signal here, which is also critical. I'll explain this more of these signals as we go on. And then you have this bearish candle that starts showing you that the market is definitely going down. So these are strong bearish candles, and it repeatedly goes down, right? So it was forming a trend. This is a downward trend, and this is a 50-minute chart, right? So this is on this platform, you can access your line graph, you can access your candlesticks and your bar graph as well. And then you can access what we call indicators, which is what I would like to discuss next. And you can access your objects that you use to draw your trend lines and your channels and Fibonacci used for analysis. And then some of these things are for when you are, I don't know, like writing a script, like a code. So you can write a code, like program a robot so that it can execute trades for you while you're not there. So you can formulate your strategy in the market and try and program it so that even when you're not there, the signals are, if the signals are formed, then the market can do an automated trade for you and execute and a trade and close it for you, right? So this was the sell prices that we were talking about when we were talking about the bid and ask. So you have your sell price and you have your buy price, right? So they usually differ. So the difference is usually the spread that you're paying to the broker that you're using with, right? So some brokers have high spreads and some have low spreads. So I think that is depending on your personal preference. You can just do your own due diligence and find out which ones are better brokers with fair spreads, right? I use XM even on my real account, so I haven't had problems with it, but you do find some other people that have problems with the broker, right? And then when you say for now, okay, you can see that the market is going down. well, in the 50 minutes chart, right? So when you're trading, you hardly want to be going against the market. So I just want to show you how when you place a trade, it affects how it appears on your trade what do you call this, terminal. So this is called the terminal. So it shows you the balance that you have, and then this is the equity. So equity shows you if you have trades that are open, it is balancing the trades that are open. So it shows you the entire balance of your account, including the trades that are open. You have running trades that you have not realized their profits or losses, right? So that's your equity. So you can find that at some point your equity can be higher than your balance, depending on how positive your cash your trade is, and then you can find that it's lower than your balance depending on how negative your trade is. If you're losing, then your equity starts decreasing, right? So it gives you a live feel of what your position is doing in your entire capital. And then you have your margin, right? So your margin reduces as you place more trades, right? So and then it varies depending on the lot size that you use as you're opening a trade, right? So I want to do an example for you. So in this case, what you're having here, this is 15 minutes. So this candle that you have, okay, let me just show you something. So these are the timelines, time frames for the market. So you have your 1 minute time frame, you have your 5 minutes time frame, 15 minutes time frame. So what it means is that this candle that you see here, it was formed within 50 minutes, right? So the candle that is being formed at the moment, it's gonna end for minute. It started at 1930, so this is an hour ahead. So it's gonna end for minute 1945. In this in our current time, it's gonna end for minute 1845, right? So if you wait until maybe 7 minutes, you will see the formation of candle complete, right? And within these candles, there are other candles that are forming, right? So then if you zoom in, which is your 5 minutes chart, right, you will see that there's these candles that are there that are forming. So what you do when you're analyzing, if you go to a bigger time frame and you see what you the behavior of the market in the bigger time frame, if you go to the smaller time frame, then it gives you a view of what is happening, sort of like in a macroscopic level, right? So it's like you're zooming into the market to see what's actually happening. So with the patterns that are formed in your 50 minutes chart, you can also see confirmation patterns that are being formed in a 5 minutes chart. For example, if you were to interpret this candle that you see here, right, this one here that is formed, you can see that if the moment when we were describing how a candle is formed with the low, the highs, and the closing price and the opening price. So this one, it was supposed to be a bullish candle, but it became a sort of like an indecision candle, right? Indecision candle, you don't have a big body, you have a very, very small body. And then, so what it essentially means is that in the beginning of this candle, you had the bears selling the most. So the market just went down to a certain level, say for that 0.066 points, right? This is a small time frame, so the points are very, very small. And then from that moment, you had your bullish people coming into the market, essentially buying, and more buying trades were entering the market. So that means that the direction of the market was changing at that moment, right? So now in your 50 minutes chart, it was sort of like forming that sort of an indecision candle, but now over time you have this candle that is just forming right now. It's not yet done. So what you do is when you're trading in the market, you wait for the candle to fully form so that you can make a proper decision. So say for example right now, a lot can happen in the next 4 minutes. So this is a 50 minutes chart. So this in the next 4 minutes, you can have a lot of selling activity going down, and then you can form another huge bearish candle. So it sort of like changes the the perspective of or the direction of the market, that you thought maybe the market is gonna stop selling at this point and then it's gonna start buying, right? So what you do is you wait for the market to finish a candle, which will be in the next 4 minutes, and then you can sort of like get an idea of what's happening. So that's essentially what you do when you are busy trading in the market, right? So when I was showing you that, I was showing you how the time frames work and how they correlate with the candlesticks that you see, right? So for this candlestick that you're seeing, which is being formed, you have now it has been 10 minutes since it has been forming. So you have about 5 candlesticks that have formed already, which we can see sorry about that, not 5, 2 candlesticks, which you can see that this is the candlestick, the first 5 minutes of the candle, which happened at 1930, and the other 5 minutes of the candle, which happened at 1935. And then this is the last 5 minutes candle, which essentially, if you sum them up, they give you that 50 minutes candlestick that we're looking at right now, right? And as you can see, most of these candles are indecision, right? So they're just signaling that the market, the bears are no longer active in the market. So you have more of bulls coming in. So the trading volume of those that are selling is decreasing in the market. So that's what it means. So let me do a trade for you now so that you can get an idea of the spread and how it appears on the platform, right? So I'm selling here. What you have, these numbers that you see here is 0.01. It's your lot size, right? So it governs your risk. It basically governs your risk. So you'll learn more about it as we are doing live trading. Then we can just see if how much risk are we, how much money are we willing to sort of like lose in order to gain certain amount, right? So that's essentially how risk works. So you ask yourself, how much money are you willing to lose in order to get certain amount of money? So it works in a form of ratio, say 1:2, 1:3, 1:4, and you usually have 1:2 as the preferable risk. So you are willing to lose 1 rand to gain 2 rand, although that is a bit too risky. But if your risk is ratio is about 1:3, 1:4, then you can make a lot of money through that. So it means it allows you to trade more while risking less, right? So because if you win, then you're gonna win 3 times of the money that you were willing to lose. So now your account becomes more profitable than the one where you have 1:2. So if you have the higher it is the ratio, 1:4, 1:5, which is unlikely. It hardly happens that you find such positions, but depending on your analysis, you can find that, right? And then usually you find those when you're catching what we call a bottom in the market or a peak in the market, right? So you find a position where, say for example, you were trading, you were selling here, then this is your peak of the market, then you sell, then you're gonna take a profit there, right? So catching this peak, it can be a bit tricky, right? So, but then we are more interested in catching the peaks as we are trading, right? So then we will go more in detail as we go further on how you can do this. So your patterns, they guide you in terms of catching these peaks and the bottoms as well, right? So you usually use reversal patterns as you're doing that, right? So now let's enter a trade. Okay, in this case, let's just enter a buy, right? So I'm entering a buy. The market is done with the 50 minutes candle. So it just formed a smaller indecision. So we're assuming that the market is changing direction. So I'm going to enter 2 trades. I'm going to enter one with 0.01 lot size, and I'm going to enter another one with 1 lot size, 0.1 lot size, so that you can see the difference in lot size. And then as I'm entering, take note of what happens to the free margin, which is this that you have here, right? So your margin controls your risk in the market, because if your margin becomes extremely lower, then you are soon to face a margin call, and then you might end up blowing your account, right? So let's enter this trade, and then click on a buy. Okay, this is the first trade. So this is what you're gonna come across as you're entering the first trade. And then they're gonna just make you read the terms and conditions of whatnot, and then click accept. For those that are interested, you can read through the terms and conditions, and in your own time. Okay, then click OK, and then now let's enter buy. Right, so we enter the buy. So if you check the difference between these prices here, your margin, and the price that you initially had, right? It shows you how much margin this trade took, right? So it took about 15.89, so it doesn't take a lot, right? Because the lot size is very small, right? And then if we now, what you see here on the other side, this is your profit, and then the profit now is negative because I told you when you enter a buy, you're gonna have the difference between the current market price being the spread that you pay. So this is essentially the money that the broker makes as you are entering this trade here. And then now it shows you how much lot size that you entered with. So that's your buy of 0.01 at that price, which is 109.149, right? So the art of trading is mainly patience and understanding the market, right? So you want to wait, but then when you are waiting to make money, right, you need to have been confident with your analysis, right? So say for example, if we buy here and then now you see that you're on a negative and you start selling, then you're just giving in to fear of losing money, and that's not what you want in trading, right? So what you want in trading is that even if you see a negative number, it does not really influence the decision that you had in the beginning, right? Provided that you did your thorough research, your analysis properly, then you can be able to be comfortable with the losing position, knowing that it might recover, because it's a matter of chances, probability that the market can go towards your direction, right? And then in this instance, I want to show you how you activate your stop loss, right? So for example, if you click on this drag to modify, if you go to your trade level, you click on the drag to modify, you push it down, it gives you SL. SL means your stop loss, right? And then now as you're moving it, if you check here, it shows you the price that you'll be losing per that trade, right? So if the market goes down, then it means that you're going to be losing, in this instance, you will be losing, if you hold around 6.99 rands, right? So that's little compared to the account that you have, right? So that's how you measure your risk, right? So with other people, it depends on the amount that they have. Some people are willing to lose about 10% of their portfolio, or I mean of their capital, which is about, in this case, it's about 100 rand, right? And then this is how you drag your take profit. So you do the same thing and then you take it on the other side, on the winning side of your profit of your trade. So you take it up, then you take it to a level where you think the market will reach according to your analysis. And then when you take it up, then you have if you hover around it, it can show you how much you're gonna be able to gain after you have, if the market goes to your direction and hits your take profit. So when you have this setup, then you don't necessarily have to be looking at the market throughout. Then you can be able to switch off your device and then just let the market do whatever it's gonna do, and then you can come back later and check how the trade went, right? So that's when you're confident with your analysis. Then you can be able to just open a trade and leave it, and then if you're winning, then it's gonna go up and hit your take profit, right? If it goes to your direction. And then what you have here, it shows you that's the volume, which is your lot size. Shows you the price that you entered at, which is that. It shows you the price of the stop loss. So if you can be able to click on it and then place it manually, so you can modify it. And if you want a direct, say stop loss, now you have a certain price. Say you want it to be at 109.15 instead of 95, then you can modify it here and put 15. And then it's gonna go down to that price, right? And then you can click modify, and then it's gonna modify it, right? So, and then that's how your stop loss will be. If you check, if you can't see it here, you can't see it here, right? If you go to the 30 minutes chart, a bigger time frame, then you can be able to see where your stop loss is, right? And then that's how you modify your stop loss. Essentially, it's the same for take profit. You can also modify it here and then maybe put 400 here. Let's just put 400, and then you can place, and then it goes to that level that is higher than the one before. And then to check how much it is, you do the same thing of hovering around it. So that's basically those orders that I was talking about in the beginning, right? And then I said I'm going to show you how the bigger lot size affects the margin, right? So if you check here, your margin was 981.2. So if you close the trade, then it does free up some margin, right? So we're gonna close this, and then we closed it. So your margin is now back to 997, right? So you have that as your margin. So then if you're opening more trades, it decreases, right? So you can open multiple trades, and then you will see how that works, right? So let me show you with the 0.01. I think in this one, when we opened, it took a margin of about 15 rands. So let's look at what 0.1 does, right? So you place your 0.1 here, and then let's still click on buy. And then you click buy. Now check the difference. So you see how significant that is. So the margin that is taken by this trade is about more than 10% of your account, right? So it means that you are risking a lot at this moment, right? So if you open trades of this nature, about 7 of them, right, you are closer to having a margin call, right? So your account cannot handle such trades. Then it will give you a margin call. Then it will close some of the trades for you so that it can free up the margin, right? So this is in this one, what the significance of this is that if I want to show you how the difference that it makes, right? In the beginning, when we opened the 0.01, we were losing about 1 rand something, 2 rands point something. So what the 0.1 does, it multiplies the number that you were losing before by 10, right? So if say we were losing 2 rands, then it's gonna multiply that 2 rands by 10. Then you lose 25 rands, right? So essentially, it's the same for the winning side. So if you're winning, if your trade was winning by 20 rands, and then on the 0.01, if you had entered it in 0.1, then you could win by 200 rands, right? So it means that you can make profits of 200 rands, right? So it is highly risky. So it means that you have to have enough capital to be able to take more trades after that trade that you're gonna take. So I want to show you how the stop loss works now. So in the previous trade, we had a stop loss at about 56, and then we were losing about 7 rands, right? If you put it at 56 pips, right? So in this case, when you put it at 56 pips from the market, you lose about 72 rands, right? So that's exactly what happens. And we had our take profit at a certain point somewhere here, if I'm not mistaken. Oh, this is the. I'm gonna show you. We were using the 50 minutes chart. So yeah, on the 50 minutes chart, we had our take profit somewhere here. So around 263 points, your take profit will be around 300 something rands, right? So that's the amount of money that you'll be making if the trade goes according to your direction, right? And then that's the profit that you make, right? But the risk to reward ratio of this trade is crazy, right? So if you check, I want to show you, so you can open this crosshairs. You can see that you are risking 54 points to gain 277 points. So your risk to reward ratio is 277 points, and then divided by your 56. You are risking it's about 1:5, right? So, and if you had caught a dip and you had done your analysis very well, then this could be a very profitable trade. And you're only risking 72 rands, which is, if you measure that against your capital, 72 divided by 997, you are risking about 7% of your portfolio, right? So that's not so bad of your account. And then that's how it works. So the more trades you open, the more margin you're taking, right? So we can open another trade, another buy. So the margin increased. It's now 317, and then you can open more and more. Then it keeps increasing your margin, 500. So you have taken half of the margin. So around 463 is remaining, right? So now, as you keep opening, there's a point where it won't allow you to open, right? So we can keep opening 636, and then another one. And now, if you hear that sound, it means that you can't be able to open any trades furthermore. So you need a higher margin to open the trade, and that's because of your lot size, right? So your free margin, we established that it takes about 15 rands on a 0.01 lot size. So if you on a 0.1, it takes 10 times that, which is 150. So you have 83. So you can be able to trade, open another trade of 0.1 of this nature. But if you decrease your margin here, your lot size here, then you can be able to, if you put it to 0.01, then you can be able to place another trade. Because remember, we only need a margin of around 15 rands to trade with the 0.01. So it then allows you to trade, to open. As you can see, you have these trades that are open here. And then you can open as many as you want up until you see your trade, your free margin is 60 rands, and then you can open more, and then it's decreasing here. And then if you open more, it decreases again, and now it can allow you, right? So you need about 15 rands, right? So as you're trading, if you're doing your risk analysis, maybe for a certain pair, then it's better you have a demo account that you're using, and then you can say, okay, with that demo account, you check how much is the margin, and then you can be able to do your risk and be able to see how much of the trade can you open, and if it goes against you, you can be able to trade and all of that, right? So we're just gonna be closing this, all of this, and then I can see the market was repeatedly going against us, but this is not our money, so it's demo, so don't worry. And if you noticed, when I opened the trade in the beginning, I did say that you're mostly influenced by the trend. So the overall trend of this market is going down, right? So what you're doing here is you don't want to be on the buying side. And if you notice, we were on the buying side, and then if you check our history here, the amount that we lost is 231, right? For just a short period of time, and it was due to the risk that we're taking in the beginning, right? It's now 7 o'clock, so I'm gonna try and wrap up, right? Is everyone following? Are you guys understanding what's happening, gaining more interest?
Yeah.
Okay, cool. So yeah, I think that's it about the platform. So I just showed you how you can open your trades and all of that. Maybe I can just quickly show you how to place a pending order. So if you come here, you can place a new order, and then if you are here, this is more like your market execution, your immediate order. So you click on the type, and then you can place your pending order here. Click pending order. So you click your buy limit, and say you want to buy at 109,200, then you would place the price that you would like to buy at 109,200, and say your stop loss you want to place it at 109,100. Your stop loss will be placed at that, and your take profit you want to place it at 109,700. Then so if the expiration time, it shows you at what time you're gonna want it to expire at, right? So for a certain period of time, you can choose today, or you can choose a specified time where now you're gonna alter this and show what time do you want this to expire. So if your order is not placed by the time that you chose here, then it won't place the order anymore, right? And then you have your specified day, then you can choose the time. And then with the GTC, it's like good till till the market till it's placed, right? So then you can be able to place it. Let me just see. So with this market, you can place a buy stop, right? So let's just place a buy stop, and then if you place a buy stop, so with the buy stop, it's gonna put a buying order at that price, and then your stop loss will be at this price, and your take profit will be at that price, right? And then if you place, that's what you get, right? So you have your buy stop at that price, your stop loss at this level, and then if you go to a higher time frame, because you can't see your take profit now, on a higher time frame, that's where your take profit is, right? It's a bit higher. Then and that's how you place it. So with the volume that we chose, we use 0.01 to place this one, this pending order. So that's how essentially the order works, and you can be able to delete it if you right click on it and then just click delete, right? Okay, I think that's just it for today, and on Thursday we're gonna try and go through the indicators that are there in the market that guide you on how to take trades. So you will go through the parabolic ZARs, moving averages, and RSIs, and so on and so forth. So thank you guys for coming through today. We'll meet Thursday, same time and same place. Cheers.
Cheers, bro.